and a warm welcome to all of you who have joined us from different parts of the world today. So today, 21st June, marks the arrival of summer in the UAE, and we bring to you the hottest topic, corporate tax. Thank you for joining us today for our webinar. We are organizing this in association with the leading newspaper in the UAE, Khaleej Times, and we thank them very much for their support. The high number of attendees today shows the interest in this topic, and I'm looking very much forward to the insights our senior tax expert will provide us with today. Just to put things in perspective, the combined tax experience of all the speakers today is close to 100 years. My name is Dana Awar, and I am the marketing manager at MBG Corporate Services. It is my pleasure to host this webinar today. Along with me, I would like to welcome our esteemed speakers, Mr. Mayur Batra, who's our executive chairman, Mr. Mahmoud Badri, who's the CEO of GCC Institutional Business, Mr. Amit Sachdev, who is the CEO of Corporate Tax, and Mr. Manoj Pandey, who is the COO of Corporate Tax. As you're all aware, the UAE Ministry of Finance has announced the introduction of a 9% federal corporate tax in the UAE on business profits, with a threshold of AED 375,000. This comes into effect from the financial year beginning of June 1st, 2023. The corporate tax rate in UAE is among the most competitive in the world and the lowest in the GCC, where Bahrain now is the only country without a corporate tax regime. Based on the public consultation document, as well as our experience in international markets, our experts will give us insights today on what can be expected from the new corporate tax regime. So let us have a look at the agenda for today. So to start with, I will give you a brief introduction on MBG Corporate Services for all of you who don't know us yet. Then Mr. Mayur Batra will deliver the keynote address. Mr. Badri will then talk about the perspective of the regulator. Mr. Amit will then provide us with an overview on corporate tax. And after that, Mr. Manoj will talk on free zones and transfer pricing. Towards the end of the webinar, we will have a Q&A. So if you have any questions, please drop them in the Q&A box, and you will either address them live today or after the webinar if we don't have the time. So MBG Corporate Services is an international professional services organization delivering sustainable strategic solutions and business transformation for clients across Asia, Europe, and the Middle East. It was established in 2002, and the headquarters are in Singapore. So MBG is a 600 members strong network, and we have 18 office hubs spread across 8 countries in Europe, the Middle East, and Asia. Our clientele includes 100 of the top Fortune 500 companies around the world and several other reputed local family business groups. In all, we serve over 3,000 clients globally. And through our core service lines of audit and assurance, legal, risk, M&A, direct and indirect tax, strategy, technology, and business setup, we help client businesses identify and tap into market opportunities, both visible and latent. The vast and varied experience of our leadership team across a wide range of industries ensures that our client solutions are not only strategically sound, but also pragmatic and implementable. MBG is also one of the impaneled firms for the National ICD program under the Ministry of Industry and Advanced Technology. So to start with, I would just like to inform you that unfortunately, since our executive chairman, Mr. Mayur Batra, is on a business trip currently, and due to him being in a different time zone, we couldn't have him join us live during the webinar. I will just introduce him briefly, and then we will play the keynote, which was recorded especially for this webinar for all of you today. So Mr. Badra has over 2 decades of experience in advising multinationals and Indian business enterprises on a spectrum of matters relating to foreign investment policy, cross-border transactions, tax controversy, foreign exchange control regulations, and corporate laws, as well as business restructuring. He has expertise in the area of international tax policy, contentious cross-border tax treaty issues in overseas territories. Prior to setting up MBG, Mr. Batra has served as the Chief Financial Officer at the corporate office of one of the largest Japanese trading houses. He has also served as General Secretary for a term of 3 years at the Japanese Chamber of Commerce and Industry in New Delhi. Mr. Batra has over the years received several accolades and recognitions. So I will now share the keynote video.
Dear ladies and gentlemen, a very good morning, salam alaikum, namaskar to all of you. I will take this opportunity to thank all of you for taking off your time to attend this webinar co-hosted between MBG and Khaleej Times. I will also take this opportunity to thank Khaleej Times for partnering with us and MBG team for organizing this event. As you all know that we living in UAE, this economy is making great strides to become one of the fastest growing economy in the world, one of the most attractive destinations for investment by millionaires and large companies. In this backdrop, this is a new legislation which on historical day of 31st January 2022 was announced by visionary leadership of UAE, announcing taxability on corporate profits for companies operating in UAE. This is a historical step because it will add to transparency, fairness, compliance, as well as it will be in sync with the global OECD guidelines for all the major economies. It will integrate further UAE's economy as a reliable business and investment hub in the global economic framework. So it is a forward-looking step, and it will add to transparency. It will add to ability of companies and businesses operating in UAE to become globalized, raise capital, become more efficient, attract partnerships, technology, and innovation. So going forward, this is going to be exciting time here. Now, talking about the relevant topic of today, which is UAE corporate tax law, we all have to understand that as on today, Ministry of Finance and FTA has issued a draft framework. So still we will have a draft law and rules and regulations coming, and we will have the final rules and regulation coming, keeping in their spirit of being an investor friendly, business friendly jurisdiction. They have asked common public like us as well as businesses in UAE to give their suggestions on the draft regulatory framework which they have issued. So it is still long way to go when we will be able to give specific insights to you. But then a broad guidance well in advance has been given to all of us to prepare and be ready. Keeping this spirit in mind, I will like to mention briefly the bright spots of this legislation. I am an optimist by nature, so I will always begin with bright spots. Bright spot is that rate of corporate income tax is announced at 9%, which is one of the lowest in any tax-friendly jurisdiction compared to jurisdictions like Hong Kong, Singapore, etc. Since corporate income tax is already there in all major economies of GCC countries, so regional competitiveness is in no way affected. The law is supposed to be transparent, simple, and easy to implement, keeping the out in spirit to be investor friendly. Most bright thing about it is that there is no tax on personal income tax. There is no tax on inheritance, no taxes on gift, no taxes on incomes from property or capital gain or dividend for qualified individuals. So keeping that in mind, it limits to taxability of corporate income tax. Here also there will be special legislation. Of course, companies with income less than 375,000 AED is tax free. Even after that, small companies and startups will have a special eased out filing as well as calculation method, which will be defined further in the law. The framework promises it. So it is going to be easy and fair to keep the tax compliance cost low for small enterprises as well as startups to basically promote innovation going further and turning UAE into a high technology and innovative economy. it is going to promote international trade and investment in big way. So free zone enterprises will continue with its tax holiday and promised tax advantages in the previous legislations in respective free zones as promised. uh, Offshore companies will continue to be tax free till the free zone and offshore companies don't do any domestic trade. So this is again a big uh, you know bright spot, and it continues to have the free zone edge over the domestic companies if you want to do international trade. uh, Further, companies in the natural resource side will be tax exempt till uh, further, there will be special regulation for uh, you know uh, transfer pricing between intercompany transactions or related party transactions. But group transactions, till you are registered as a group, intra-group transactions will be free from tax, which is a very unique, a very innovative step, since we have this regime of various licenses and in same group various businesses being done, which is a very unique first time regulation I have seen in any other, compared to any other tax jurisdiction. There will be zero withholding tax on foreign remittances and payments, which is in itself a very unique step. There will be benefit of DTAs being provided and so on. So there are a lot of innovative bright spots in this legislation. On the negative side, of course, all of us will have to restructure our books, because we are used to free zones, companies doing multiple kind of trades, businesses, and so on. Now the exemption is limited to till their businesses are all offshore. We will have to be very careful about group registrations, because intra-group transactions will be tax-free, but the group registration has to be strongly based on certain level of ownership in all the group entities being controlled by the same owner group or owner respectively. Similarly, we will have to be very careful about mixing of personal and business assets and activities, because personally we will be tax free, but if we are doing something as a business activity, for example buying selling land or any trade and so on, it will be taxable. So keeping this in mind, this is an exciting time for all of us. We have enough time to prepare. It is a very fair, just, and I can say low tax rate regime which we are coming with. Now I will, keeping in view our MBG's experience of global introduction and rollout of corporate income tax regimes world over, I will like to point out few areas which all of you should keep in mind while restructuring your businesses and preparing them for corporate income tax, which are frequently issues of argument or future litigation with the tax authorities. First issue is about determining the jurisdiction of income. Second issue is about determining the accrual and arisal of income in UAE. Third issue will be most important, will be nature of income, whether it is revenue received or capital received, because only revenue means income. So first three tests will be jurisdiction, accrual arisal, and revenue capital versus argument. Once these three tests are properly done, then the right to tax in UAE will be duly established. Going forward, there will be issues on depreciation, uh, treasury transactions, foreign exchange transactions, foreign asset and incomes, because of foreign exchange very valuation variation changes, capital work in progress, starting of a business date, carry forward of losses, carry forward sharing of intra-group losses, uh, you know, mm, uh, uh, opening and closing stock. All these issues will be very important for computation of income, which will be based on accounting profits and IFRS. So we have to get our books ready for it, and in a fair way, transparent way, be ready to scrutiny in future by the tax authorities on all these issues. Albeit we'll have to also continue to face challenge to have uh, arm's length between personal operations and business operations, because till now, because of lack of any taxes on corporate tax and personal income tax side, a lot of us and companies have those very much mixed into it. So these are the issues which we all should keep in mind while getting ready for this new corporate tax regime. We at MBG will give you more detailed information, because my esteemed colleagues who have detailed uh, experience and knowledge from consulting, regulatory and business side are going to speak more in details about the detailed provisions of, of the draft framework. And we, as your partners in growth, eh, will be more than happy to help all your businesses prepare for this new upcoming law, and helping you restructure, restate, or making you ready for a fair, fair disclosure, as well as preparing you to recognize and handle any future issues which may arise. So this is where I will like to stop, and also at the same time thank the visionary leadership of UAE to continue to make UAE a most preferred investment destination, global business hub, as well as a transparent, integrated global economy. So we all will benefit from the growth and this great initiative from UAE government. So thank you very much for your patient hearing, and I will pass it on to my for further discussion to my colleagues. Have a very nice day.
Okay, so after this very informative and insightful speech, I would like to move on to the next keynote, which is from a regulator's perspective, as the next speaker is Mr. Mahmoud Badri, who has a rich experience with the Federal Tax Authority. Mr. Badri, as mentioned, is the first Emirati CEO at MBG. And he has over 3 decades of rich finance and accounting experience across the government, semi-government, and private sectors. At the Federal Tax Authority, he became the first head of tax returns and payment department in UAE history. Prior, he was finance assistant director at Dubai Airport Free Zone, where he worked for 14 years. He had also served in the UAE Army for 17 years before that, and he has been awarded by the UAE government for his performance many times. With that, I would like to please welcome Mr. Badri.
Thank you, Dana. Assalamu alaikum. First of all, I would like to introduce myself. My name is Mahmoud Badri. I joined MBG recently, and I'm so glad and pleased to work with Mr. Badri and his great team. So, regarding the corporate tax, is the corporate tax implementation would be similar to the VAT implementation that back in 2017, or it will be much better and smooth process? First things, the important things that I would like to say that we need to see the topic, issue, case, or any objective from different angles, from the outside of the organization or from the operation itself, from inside. Being a major element of FTA staff as was handling all type of return procedures, payment procedures, and refund procedures, and also deregistration and some part of registration. So overall operation of the main activity of the FTA I was handling. Therefore, is it very important to see what outside is seeing and what we are seeing. So If you go back to 2016 and 17, I think all of you know that government announced that UAE will implement VAT in 2018, January 2018. But few companies or some new citizens that they go to understand what is the VAT, what is the meaning of VAT, how the VAT will be proceed, what is the element of VAT, is all the transaction and services goes out will be added the value of the tax or not. Most of the companies, they thought that, okay, the government, UAE government leaders will postpone the implementation like other Gulf countries. But in 2018, January 2018, what happened? What was implemented? And it was a main gap or challenges that most of the companies, businesses, and public citizens, they don't know what exactly the VAT itself. During the last quarter of 2017 for registration in the VAT, I saw a lot of people, clients, registered, non-registered, they are coming to the FTA office to know how to register, what's meaning of that, how they can proceed the VAT. It's such as whenever we are going out from the office during the working time, after the working time around 5 or 6 o'clock, if somebody goes from Dubai to Sharjah, you will see a lot of cars, traffic jam in the Sheikh Zayed Road, Mohammed bin Zayed Road, and Emerson. Similar was happening in 2017, last quarter, and first quarter of 2018. Now, after 5 years of implementing VAT, is the same scenario will happen to the corporate tax, or VAT FTA has something else to do? I believe, and I'm sure that FTA took the initiative of VAT implementation to study the gaps, understand the market, behavior of the market, behavior of the register, to make a model of implementation of corporate tax. The major things that happened to FTA during I was working with them, that whenever the process need to be modified, they are publishing a new guide that the interpretation or the process is already changed or replaced or modified. Policies were amended. And most important thing that they were listening to the audience, to their clients, to the public. They participate in different, as a benchmark with other countries. They are implementing the OECD. So many things happened during this 5 years, and now I'm sure that people or staff at FTA, they are working together and they want to proceed with the corporate tax with a smooth procedure, unlike the VAT. So we are building the road for us to work on it. FTA and Ministry of Finance, we are all completed their application, I think, just few matter of publishing the law. So their obligation for the public is completed. Now it will come our job that we should comply with their regulation. We should work together to work the FTA and government through. To summarize my perspective, that I would like to say that pre-preparation for VAT implementation was different than corporate tax. In corporate tax, the people, the staff, everybody has a knowledge of VAT. The same scenario they are thinking that they will implement. Now is better. They have the knowledge, they have the skills, they have the experience, they know the issues, they know where is the gap, and even the gap is still there, they can solve it. all the issues that they come rising from the government, from the business sectors, from the public, they can solve it for sure. And the knowledge of the VAT is like a standard for the corporate tax. So they are aware of all the knowledge. They are sharing the knowledge, whether the webinar, seminar, workshop. Even the companies now is more mature than before. I didn't see a lot of webinar and seminar in 2017 or 2016, but now every day I saw a new company that they are providing this scenario, this information. And most of important things that I already mentioned, that FDA now, they are approaching the clients unless clients approaching the FDA. Now it is our obligation toward FDA to implement those procedures in the right process, in the right manner. Thank you very much. And I hope that I add what exactly happening in the FDA from the operation side.
Thank you so much, Mr. Badri, for providing such rare insights. Now we move on to the part which you have all been waiting for. So overview of UAE corporate tax with Mr. Ahmed Sachdev. Mr. Ahmed Sachdev, welcome.
A very good morning to all of you. Thank you very much.
So Mr. Ahmed, let me just start by briefly introducing you to our audience. So
yes, sure.
Mr. Sachdev has 22 years of experience, including over 3 years in the GCC across the domains of tax laws, accounting, foreign investment, foreign exchange control regulations, and corporate and business laws. So Mr. Ahmed, if you would like to proceed with your speech.
Yes, sure. A very good morning to all of you. It is indeed a pleasure to be speaking before such a large audience and in partnership with Khaleej Times. I'll be running through you very briefly on the overview of corporate tax regulatory framework as it emerges out of this public consultation document in terms of its coverage, in terms of its applicability, in terms of the calculation methods and policies which have been proposed in this law. Implementation of corporate tax regime follows several regulatory reforms in UAE in the past years, which is nothing but a very good assurance of building up of a robust regulatory framework in UAE. The proposed corporate tax regime incorporates the best practices, principles that are internationally known and accepted. Interestingly, government has refrained from introducing any new concepts, aiming an easier transition and minimizing the compliance burden for business community. The Federal Tax Authority has been designated as supervising regulating agency for corporate tax regime. And it merits mentioning, very important, that 1 full year has been given to the business communities and the stakeholders in their readiness journey, and in carrying out an impact analysis and planning their actions and decisions, including reorganizations of their businesses, to avail all possible concessions, exemptions under the proposed corporate tax legislation. Now, I will start with, how this taxation structure would move forward in terms of who will be taxable, how a taxable person would have to pay taxes in UAE, what will be the scope of the income which will be offered for tax, and how the taxes would have to be calculated. So the UAE CT regime don't bring in any parallel tax on the income of the individuals. Instead, the individuals who are engaged in business or commercial activities in UAE, whether as a sole establishment, as a proprietorship, they'll have to pay taxes. The key decision criteria would be judged based on whether individuals have a commercial license or a similar permit from any UAE agency. The employment income and any other personal income such as dividends, rentals, they will not be subject to tax. Likewise, for a private or a family trust where beneficiaries are individuals having rent or dividend income, they will also not be required to pay any tax in UAE. When it comes to general partnerships, unincorporated joint ventures, and association of persons, they will also not be considered as taxable entities. Instead, the members or partners, they would be taxed on the profits earned by such associations and entities in their individual capacity. You can move to next slide. No, I think previous one. Now let us talk about corporates. How the corporates would be classified. So there will be two classifications. One would be a domestic entity and second would be a foreign entity. Domestic entity will be somebody which is incorporated in UAE and having a separate legal status. And this will also include limited or other partnerships where liability of partners are unlimited. So this would be one set of legal persons. The second set of legal persons would be foreign entities. These would mean those entities which are incorporated outside UAE, but they have a permanent establishment here in UAE, or they have a place of effective management in UAE. And this would also include foreign incorporated partnerships. Next slide, please. At the same time, there is a list of exempted persons or entities who are not subject to any corporate tax. And this exemption would fall in either under automatic route or you'll have to obtain a specific approval from FTA. Broadly, we have listed 5 categories. One is federal and emirate governments, which are carrying non-commercial activities. But they will, the government would not have any exemptions in case they carry out any commercial activity under a trade license. Likewise, any wholly owned government companies who are engaged in sovereign activities would be exempted. Entities which are engaged in extraction and exploitation of natural resources, charities and public benefit organizations, and investment funds. Social security and retirement pension funds are also exempted from tax. When it comes to charities, they will have to obtain an approval from FTA. And as long as the approval is in place, they would remain exempted. Next slide, please. Once we are clear as to what is a taxable person, individual or a legal person, and what is an exempted person, then we move to judge the residency. So tax residency would be one very important aspect which would determine the scope of taxable income in UAE. So legal entities incorporated in UAE or individuals who are carrying business or commercial activity will be considered as resident persons within the ambit of UAE corporate tax. And any other foreign company will also be regarded as resident if it is effectively managed and controlled in UAE. Entities which are not residents will be treated as non-residents under corporate tax. Next slide. The scope of income would be determined based on the residential status. All residents will have to pay corporate tax on their global income, subject to a few exemptions, which I'll deal at the later part of my presentation. And individuals will also have to pay tax on income which they are earning from business activities in UAE. Mind you, the salary income, rental income, dividend incomes are not taxable, but once you carry out any commercial or a business activity, then individuals also will be liable. Likewise, non-residents will also be taxable, but the scope of their taxable income would be dependent on whether they have a permanent establishment in UAE or not, and whether they have any UAE sourced income. So the concept here would be source income taxation, situs-based taxation, where wherever the source or situs would lie in UAE, that would fall as a part of taxable income. And examples of UAE source income could include any income which we earn from a contract performed in UAE, any income which we earn from assets which are located in UAE. And the concept of permanent establishment shall mean the place of business, as is mentioned in Article 5 of OECD Model Tax Conventions. UAE also has a great amount of network in terms of tax treaty, Those relevant tax treaties would also have to be looked into. But essentially, OECD Model Tax Convention could be a very basic framework for judgment of a PE in UAE. Next slide, please. Now, this slide talks about the group structure. So, businesses which are engaged into multiple businesses through multiple entities, they have been permitted to form a group, which means the results would have to be consolidated and one single entity would be filing a single corporate tax return. But to form a tax group, there are few conditions which have been laid out by the public consultation document. The key condition is that there should be a minimum shareholding and voting rights, direct or indirect, of at least 95%. Similarly, none of the group entities should be considered as exempt persons or having businesses in exempt in free zone area, benefiting from 0% tax rate. And the consolidation would have to be for the entire group entities. We will not have opportunity to choose few and leave others. And another important condition is that we should have a single accounting period. We should have uniformity in the accounting period. Multiple periods would not be permitted for forming a group structure. And next slide. So now let me deal with three exempt category of income. One is dividend, next is capital gain, and the yet next is the profits from a foreign jurisdiction. So here's an illustration of a company which is incorporated, say in UAE. We call it H Limited, a holding company which has a subsidiary in a free zone. S2 has a subsidiary in mainland, S1, and also has a subsidiary S3, which is outside UAE. So as long as the holding company earns dividends from S1 and S2, which is from the UAE, the dividend income would be tax-free. The thought behind this exemption is that these UAE entities anyways would be paying taxes on their profits. So it makes no sense, when these profits are distributed by way of dividends to the holding company to tax them again. So this will lead to a double taxation situation. So that is the reason why these have been exempted. Now let us deal with the situation when the H Limited has a subsidiary overseas. So overseas subsidiaries dividend income are also tax-free, but there are two conditions to be met. One is that the holding company should have at least 5% shareholding in the overseas company. And second is that overseas company in the foreign jurisdiction should also be paying tax. So the tax should be at least 9%, which is equivalent to the tax rate proposed for UAE. So they don't want a situation when you pay tax at 2% in foreign and you claim an exemption of 9% here in UAE. So this is not permitted. So at least 9% criteria would be important for claiming an exemption of dividend. So we can move to next slide. So likewise, capital gains from sale of shares in companies in mainland free zone or outside UAE are also exempted from tax on the capital gain earnings they have. So the condition here is when we talk about a jurisdiction which is outside UAE, the same conditions are applicable, means there has to be a minimum shareholding of 5% by H Limited, and the foreign entity must also be paying taxes, which is equivalent to 9%. When it comes to the capital gain from mainland entity, that is exempted. And when it comes to for a free zone entity, there are some conditions. One, such a free zone should be a holding company and it should be earning majority of its income. Substantially, the income receipts should come up from the entities who are meeting the participatory exemption criteria, means 5% and exemptions. So this is something which probably we'll have to look more carefully once the final law is announced. But as of now, this is what the public consultation document speaks. So the next slide. Now this deals with a branch profit. Say a UAE entity is having a branch overseas, and what would happen to the branch profits earned in overseas jurisdiction? So here UAE businesses have been permitted two options. One is either you pay the tax on the foreign branch profit and claim the credit of taxes paid overseas to avoid any double taxation. Second is that you don't consolidate branch profits and just pay taxes on standalone basis. And whichever options you choose, one of these options, then that is irrevocable, means you cannot change your mind later. And while claiming this exemption, the businesses would have to consolidate the results of all the foreign branches. You cannot again pick and choose here. And another important condition is that foreign branches also should be paying sufficient level of taxes in their jurisdiction in which they operate. So these are three important exemptions which are being proposed in the present public consultation document. Now, this is, the way we can calculate tax here in UAE, illustrative tabulation. So we start with the accounting profit, which is flowing out of your financial statement. And then there are certain disallowances which would have to be adjusted. For example, interest expenses. In case I operate from a loan fund, then 30% of my EBITDA on interest exposure, that is the maximum I can enjoy as interest deduction. So 100% is not permitted here. Likewise, if I make spendings on entertainment to my shareholders, partners, customers, suppliers, 100% is not allowed. 50% is the threshold for claiming a benefit of entertainment expenditures. Any fines, penalties, any personal expenditures, any capital expenditures, any expenditures prior to the period for which tax is being computed, those would also be disallowed. And likewise, we will have to remove the exempt incomes from the taxable profits, whether by way of dividends, capital gains, foreign branch profits. And special allowances incomes, probably there will be some more adjustments, although public consultation document does not speak much about it. So this is the method by which you will make a calculation of your taxable profits, which would be subject to 9% tax. Next slide. Now this is the way as to how the tax liability has to be calculated. So from the previous slide, we reach a figure of net taxable income. Then up till 375,000, we have a 0% tax rate, and any income which is in excess of that would be subject to 9%. So by making this calculation, we would reach a number of corporate tax liability. Then we'll have to reduce this from the foreign tax credits if we have some in other countries. And the remaining amount would be something which will be classified as the corporate tax, which will have to be deposited. Interestingly, UAE doesn't, ask you to do a provisional tax filing or provisional tax deposits. This is compliance once in a year after the year ends. So within 9 months, you have to make your tax deposits and file your tax return. The next slide. Yeah. So these are some key important administrative aspects for the corporate tax. One is that businesses would have to register themselves with the FTA and obtain the tax registration. Second is, after I complete my tax filings, FTA would have a right to assess my returns and issue an assessment order. Once that's done and I have any dispute or any disconnect in the way I have been assessed, I will have a right to litigate and dispute on the same by opting for the appellate mechanisms. And once the final law is announced, we'll have clarity as to how this appellate mechanism would run in UAE. But the important aspect is we will have a right to appeal against any assessment done by FT. Next slide. Okay, so I think this puts an end to my area. And I am again thanking all of you for your participation in this large number. It was a pleasure to speak before you, and I am sure that we'll be able to assist you in times to come as you prepare yourself for UAE. And I'll pass on to Dana, and that will follow my colleague, Mr. Manoj's session. Thank you very much.
Thank you, Mr. Ahmed, for making such a technical topic so interesting and simple for all the attendees today. So our next speaker is Mr. Manoj Pandey, who will be taking on a free zone and transfer pricing concepts. So Mr. Pandey leads MBG's tax practice in UAE and GCC, specializing in development of tax strategies, transfer pricing, BEPS, cross-border taxation, and M&A services. Mr. Manoj, you can go ahead.
Thank you so much, Nana, and good morning, everyone, and thank you for joining in. So I'll be taking the topic of free zone, which is a very, very important concept because it offers a 0% tax. So if you see a free zone, you will see a lot of free zones here, and there'll be suddenly a rush, to form an entity in a free zone so that you can enjoy a corporate tax exemption. So when we say a corporate tax exemption is available to all the entities, whether it is registered as a branch or as a LLC entity. So the most important point here is that the entity established in free zone, it should have a substance, and it should be subject to all the regulatory compliances as prescribed by the free zone authority. So when we say a substance basically means that the entity should be existing on its own. It should not be dependent on an outside support, either in a mainland or support coming from overseas. So from that perspective, all the entities which are established in a free zone will have to relook into their operation as to how they are structured and how they are performing. Another important concept that they have introduced for free zone is that free zone entity can also be regarded to have a permanent establishment in a mainland. So this is a concept, which was actually applicable to an overseas entity. Now this has also been made applicable to a free zone entity, which typically means that if a free zone entity has, some key personnel in mainland and they are getting the business for the free zone entity, then in such a case, the revenue of free zone can also be taxed, mainland entity. Therefore, it is very important for a free zone entity to operate on its own, to have a substance of its own, to have its own employee, own assets, and its own customers. That is very important, and that is something that we all need to look into in order to enjoy a 0% corporate tax on a free zone entity. Now, if you go further, so if you see on the left-hand side, we see outside UAE. So a free zone entity in UAE, if it transacts outside UAE, income will be exempt. And if you see on the right side of the free zone, the UAE mainland, the four type of incomes can be exempt. So one is that, if a free zone does a transaction with its branch in mainland, then in that case, such income will be exempted. Or if it derives any passive income. So passive income, basically we say as income in the nature of royalty or, dividend or capital gain, those incomes or interest income, those are passive income. So those incomes will be subject to 0%. Transaction with group companies. So group companies basically means that, holding subsidiary company or a sister concern. Those companies, if you transact, those will be outside the purview of taxation. And any sale of goods from a designated zone to a person who is an importer on record, that will also be exempt. So other than that, if a free zone entity transacts with any person in a mainland, those transactions can jeopardize the tax exemption of a free zone entity, and all the income earned by a free zone entity could be subject to a tax exposure. Moving further, there are, of course, since it provides a 0% corporate tax, so there is a lot of incentive for entities to restructure businesses. So when we say restructuring typically would mean that, if a mainland entity, if it is deriving an export income, so if it would like to shift the export income to the free zone entity so that it can enjoy 0% taxes. But before you do that, first you have to understand what is the net profit of the mainland entity, whether it is making a profit of more than 375,000 or not, and what is the projected profit going forward for next 5 or 10 years. And then based on that, a decision has to be taken. Because when you move the export revenue from mainland to a free zone, we have to also create a substance in a free zone. So creating a substance will mean that you need to also shift employees to the free zone. You need to also shift your assets. You need to have a customer. They should either be based in a free zone or the customer should be outside the free zone. And there has to be no connection of the free zone with the mainland entities or any person in mainland. I'll give you a typical example. Let us say you establish a free zone branch and there is an entity in a mainland, and the entity in a mainland have a key personnel, and those are the people who are actually signing contracts on behalf of a free zone entity. In such a scenario, free zone entity can be denied a tax exemption because it will not be regarded to have a substance in the free zone, because the people are sitting here in mainland and they are actually running the show for the free zone entity. So in that scenario, it will not make sense to restructure. So restructuring has to be done carefully, and it has to be also considered with all the aspect of corporate law and the labor laws, as well as the FDA regulation, etc. Now going further, so this is what all about. We talked about free zones. So free zones are of course very important, and one has to take a very informed decision whether you have to opt for a 0% tax or you want to do not opt for a 0% tax. Both the options are available. And if you have to opt, then all the pros and cons needs to be considered properly. Now on the transfer pricing, this is another concept, which is gaining a lot of interest here in this part of the world, because we see there are a lot of, group company structure here, and UAE also has been, international hub and regional hub for the companies doing businesses here. So first we understand what is transfer pricing and why transfer pricing. So if you understand transfer pricing basically means when two related parties, they transact with each other, we call it as transfer pricing. So in order to do a transfer pricing, there has to be a related party. Two parties need to be related and they should be transacting. When we say transacting, the transaction could be in the form of supply of goods, or it could be in the form of supply of services. It could be intangibles, or it could be any, other transaction in the form of interest, borrowing, etc. So if you see on this slide, we have talked about 4 areas. So first is on the applicability. So when we say applicability, the accounting law or the commercial company law, they also define what is related party. So when they define a related party, it is already there in the financial statement and the transactions are reported as related party. However, in case of a corporate tax law, the related party is defined little narrowly vis-a-vis what we have a definition in accounting or in corporate law. So that is something that we need to check. So applicability has to be seen that whether the transaction is related party or not. Secondly, there has to be a transaction between the two parties. It's not that just by two parties are related, they'll have to do the compliances. There has to be actual transaction also happening. Now the second question, what is the need to have a transfer pricing? So the need to have a transfer pricing arises because when two parties, they are related, there could be a possibility that they may transact in such a manner to manipulate the profits or to reduce the turnover or sales or to increase the expenses. So with the ultimate objective is to reduce profit at group level and pay lesser taxes. So this is a concept which has been very much there in the worldwide scenario, and the tax authorities, they put in the provisions to check these bad practices, and therefore we have this transfer pricing law or the regime. Now, how the tax authorities they check on these? They follow 3-step approach. So first of all, we need to identify what are the transactions. And then secondly, we need to also do a functional analysis as to between the related party, who is doing what are the assets, who is having which assets, how much each entity is assuming risk, and what is the nature of transaction. And then we need to do a benchmarking analysis to establish that the transactions carried out between related parties at arm's length price or not. Arm's length price basically means that if the two parties, if they had transacted with the unrelated parties in an uncontrolled scenario, whether the prices would have remained the same or it would have been manipulated. So this is an approach that we need to follow to justify the transactions are at arm's length price or not. Now going further, so in the functional analysis, there is a 5-way approach that we follow. First of all, we have to, determine the functions performed by each enterprises, then identify which entity is doing what, then identify whether these are tangible assets or intangible assets, how the assets are employed. And then we have to categorize, based on these analysis, we have to categorize the roles of each enterprise, and then we have to determine the pricing. Now moving further, conducting economic analysis is a very, very important aspect. So here one has to first identify which is the most appropriate method. So we have seen traditionally that comparable uncontrolled price method has been preferred, especially like countries like Qatar. But here in the consultation document, we do not have any preferences. And then we need to also select the tested party. So tested party is to be selected who is performing more function. So let us say if an entity here is performing a lesser function, it would make sense to also select another party on the overseas country as a tested party. And a profit level indicator has to be chosen. So generally we choose the profit level indicator based on the risk profile of the associate enterprise. So, and then the profit level indicator could be return on investment. It could be profit divided by the operating cost. In some cases, it is profit divided by sales. So those profit level indicators will have to be considered. The selection of databases is also very, very important aspect. So in this part of the world, the database is an issue. So generally, we have to refer to certain databases. Those databases will have to be generally prescribed by the tax authorities. And then this selection of comparable companies and arm's length price will have to be determined. Moving forward, so there are the regulation says the OECD guidelines will have to be followed. So OECD guidelines prescribe transfer pricing method. One is a traditional transaction method. One is the profit level method. So mostly all the methods are profit linked except for comparable uncontrolled method. And then based on the specific facts and circumstances, we have to apply a given method which suits the tested party. Now moving further, there are certain practical aspects that we need to follow. So those practical aspects are very handy, and the major challenge comes when the entity here is making a loss. So if an entity is making a loss here, and if they have a huge amount of related party transaction, then the task for the consultant becomes very difficult to justify that whether the transaction with related parties are arm's length or not. In such a case, we have to relook into which methods to be followed, whether internal method or external comparable method will suit, which tested party should be chosen, because here if you're making loss, it would make sense to, choose another tested party which is sitting overseas. Choice of public available database is also very important. So let's say if your entity is making a loss here and, the entities across the industry is also making losses. So it would make sense for us to choose a database here in UAE and not to go for any other region like Africa or Europe. Geographical region, exclusions, and then whether we have to go for a single year data or a multiple year data. and the treatment of certain expenses like non-operating costs, etc., will also be very important when we have to determine the arm's length price. So the UAE is now, when we talk about transfer pricing from UAE side, here, going further in the subsequent slide, the related party, the OECD, their related party transfer pricing, they are borrowing the concept from OECD. So OECD, which is internationally accepted as a best practices, will be followed. And going further, so related parties have been defined. Related parties have been defined based on the ownership criteria and control criteria. So here, the related parties are defined at a 50%. And if we see in other part of the world, especially in countries like KSA and Qatar, the same 50% has been followed. But if you go to other countries like India, there the yardstick is 26%. Now, besides related party, connected person is also defined, but here there is no such threshold of 50%. And here, any individual who's owner, who's a shareholder, who's a direct director, or who's a relative of such owner or director, they'll be regarded as connected person. So transaction with the related party, whether domestically or internationally, will be covered transaction. Going further. Now, if you see here, in this case, a simple example in H Limited, which is outside UAE, S Limited outside UAE. H Limited has a UAE mainland entity, S2. H Limited has a permanent establishment in the form of S4. So S1 Limited has a S3 Limited as a UAE free zone. So in this case, if S1 Limited does a transaction with S3, it has to, S3 will be subject to transfer pricing compliances, despite the fact that S3 is a free zone entity and is enjoying a 0% corporate tax. Same way, S2 Limited and S4 will also have to do the transfer pricing compliances. Let's go further. Domestic and connected persons. So we talked just now that domestic transactions are very wider, and then it will cover everything here. So in this case, if in the domestically, S3 Limited being a free zone entity, if it transacts with a mainland entity, or if it transacts with S5, which is a mainland branch, or if it transacts with any of its shareholder owners or key manager personnel, all these transactions will be subject to the transfer pricing, compliance and benchmark. So here we have to follow 3-tier documentation. So TP disclosure form will have to be now filed. This generally is filed along with the tax return. There could be a threshold, there may not be a threshold. So this is something that we have to wait. Local file is basically a transfer pricing study, which documents all the transaction related party and documents the industry overview, functional analysis, and economic analysis. Then we have to also, the local file is generally has to be either filed along with the TP disclosure form, or it may not be required to be filed. That is something we have to wait and watch. So master file is again a filing requirement which is applicable based on certain threshold. And this is, a blueprint of the whole transaction by transaction. And then of course, country by country reporting, where, filing has to be done on a jurisdiction basis. And this filing is generally after the filing of the tax return. The impact, if we see whether you talk about domestic compliances, whether you talk about for free zone, or whether you talk about for transfer pricing, there is a 360-degree compliances or impact which needs to be understood by each entity. So whether it is, for the structuring perspective, that, whether you are a related party or not, or whether an entity can form a group or not, whether losses can be carried forward or not, or whether losses can be transferred or not. So entity structuring is very important. Your IT or your accounting module is very important, because additional ledgers, additional invoices field will have to be created. Same way, your profitability and margins will have to be relooked into, because your margins may have a hit because of the corporate tax, business processes, your supply chains, and your transfer pricing related party transaction will have to be carefully relooked, and documentation and compliances will have to be properly planned. Let's go further. So we in the MBG group, we can advise, and rather we are advising so many of the companies here in 3 phases. Phase 0 is a diagnostic review that we are studying the existing structure, the transaction, the group levels, and where the inefficiencies are with respect to structuring or with respect to the transaction level. And then based on those analysis and impact assessment, we can identify the leakages, and we can identify the areas which require strengthening or improvement. And then once we have the draft law and the decree law and executive regulation, we can help in implementation and transition. And along with implementation and transition, we can also help companies in obtaining registration and filing the year compliances on year 1 and going forward. Basically, as you know, that this corporate tax has to be properly implemented, because any laxity here or any improper planning could lead to interest, tax, and penalty exposure. Even though the tax authorities, they are saying that they'll be bringing in simple and easy to follow corporate tax, but the corporate tax as such is not an easy subject, and it has, because of transfer pricing, it's subjective, and there are certain gray areas, whether you treat particular expense as a business or not, or whether it is a business profit or a revenue or a capital. All these areas are we have seen that requires a lot of deliberation and requires a thorough analysis. So that is it on the free zone and transfer pricing. So we hope that the session was useful, and now we are ready to take questions.
All right, so thank you, Mr. Manoj, for this very insightful information. So we've received a lot of questions even before the webinar started, but due to the constraint of time and due to having an overwhelming number of questions, we're only going to be taking a few. At the same time, obviously, if you would like to reach out to us for further questions, you can type in the comment box. So you can type 1 to send a mail. We can respond to your mails, to your questions by mail, or 2 to request for a one-to-one meeting, where we can elaborate further on your questions and concerns. And 3, you can request for a workshop, where we can conduct a workshop for your company on corporate tax with our team. So the first question would be, if a UAE company earns dividends from some other local company or foreign company, is it required to pay corporate tax?
Okay, actually, dividend income would be tax-free. And if it is coming from a foreign land, then there will be 2 conditions to be met. 1, UAE company should have a 5% shareholding. And second, the overseas company should be paying at least 9% of tax.
Okay. All right. Thank you, Mr. Ahmed. Now for question number 2, are foreign companies taxable in the UAE?
Yes, actually, if foreign companies have local entities in UAE, surely they are taxable. And in case they don't have any local entity, then their taxability would have to be computed based on whether they have any kind of a permanent establishment presence or they have any UAE source-based income.
All right. Moving on to question 3. So exports done by mainland companies would not enjoy any incentive vis-a-vis a free zone company. In this case, will it be beneficial to carve out the export business into a free zone company?
In this case, you see, export income for a mainland entity is a taxable one. That is one. So it would make sense for a mainland entity to carve out it and bring it to the free zone. But in all cases, we cannot say that the same position can be taken. We need to do a proper analysis. that whether with the transfer of revenue, whether a substance can also be transferred to the free zone or not. So that is one. And secondly, even for a mainland, even though the export revenue is taxable, but if the foreign, I mean, if the revenue has already suffered a tax in overseas country, so here, it would not make sense to transfer it to free zone where, the mainland entity can enjoy foreign tax credit and eventually it may not be paying any further taxes. So we need to do a proper analysis and we cannot say straightforward that, in all cases, it would make sense for an entity to set up a free zone branch or a free zone entity.
All right, thank you very much. Now for the fourth and last question, also about free zones. So the sale of goods by the free zone company, which is enjoying 0% corporate tax in the mainland, through a mainland registered branch is permitted. In such case, will the branch be required to maintain separate books of accounts?
In such a case, actually, a free zone entity, they can enjoy the exemption, but for a branch, it will be subject to normal corporate tax. And when it will be subject to normal corporate tax, I mean, they have to maintain some records to establish that what kind of an accounting profit and what kind of a tax liability, they have arrived at. So without, books of account, it will be very difficult for a branch to justify that the profits are adequate. Even though public consultation document is silent, but in our view, of course, they should be maintaining proper records and separate books of account.
Okay, thank you very much, Mr. Manoj. I would like to remind everyone who has any questions, you can type in your question into the chat along with your email address and we could respond to you by email. Of course, if you would like to request for one-to-one meeting or for a workshop, just type in 2 or 3 and as well with your details and we'll get back to you. Once again, I would like to thank all of the attendees and our esteemed speakers, as well as Khaleej Times. This has been a very engaging session, and I hope you found this time very useful and informative. We'll, of course, continue to organize many knowledge sessions like this in the future, so do follow us on LinkedIn, Instagram, YouTube channels. The links are in the Q&A box. Thank you once again, and wish you a great week ahead.